Hey guys, this is Terry with Futures IO. Today we have a presentation from Futures Trader 71 that will be covering the no-nonsense approach from plan to execution. If you have any questions, you can type them in the questions box and we'll do our best to answer them after the presentation. If you're watching this on YouTube, please do us a favor and give us a thumbs up. If you enjoy the webinar, it helps us a lot. Also, please feel free to just subscribe and share this webinar. At this time, I'm going to hand it over to FT71.
All right, so I'm going to try to make this not one of those epic 3-hour webinars like we've done in the past. I'm going to do my best to fly through this material because I want to get to the actual conversation as opposed to just you listening to me talk. So as Terry said, the topic is the no-nonsense approach from plan to execution. It's actually from getting up to execution when I go over the routine, but this was a discussion that we've had with Futures IO, and it may turn into a series because there's so much to cover here, and a lot of it has to do with what I've learned by watching not only backing traders over the years as a prop shop, but also what I've learned here at Stage 5 as I interact with traders, what the pitfalls are. So what I'm discussing with you, in other words, is based not on some theory or something like that. It's really about experience, what I see people struggling with, and what I attempt to do to help them deal with that. First of all, I want to mention that derivatives trading involves substantial risk of loss. It is not suitable for all investors. Past performance is not indicative of future results. So the first thing we want to talk about is the amateur's approach. So here I'm going to very quickly run through what the process is from my perspective of those people who want to come on and become traders. And this applies to stocks, futures, Forex, whatever you do. It is basically the same process. In fact, it's the same process when we approach anything in a competitive field such as trading. The amateur's approach, stage 1, how hard could it be? This is the thought process, right, for the amateur coming in. How hard could it be to trade? I can do it. I'm awesome at doing other things. I'm special, so I can do this. The market can't hurt me. I just need to put up some money, to put some money in into a trading account and catch that $1 million trade. That's stage 1. Everybody comes in with this high hope, and they've seen someone else trade, or they've heard of someone else trade, or they've watched a trading movie or something and figure they can do this as well. This is when stage 2 sets in. Stage 2 takes a very vast amount of time in the learning process. Stage 2 is when you start to recognize that, wait, maybe I don't know what I don't know. And generally it starts with, I just got ripped. I can't believe I fought the market like I did. Probably lost a huge amount of money or a big portion of an account. This is really scary, but I know it can be done. I'm going to go learn all there is to know about trading. I'll be back with the best trading system ever. This is where most traders get stuck, in my opinion. From here, most folks struggle to be persistent and form habits. Results are random. There's a struggle for structure in general. So this is what I've been focusing on a lot in my conversations on Futures IO, or Big Mike as it was called. Is this process, because the bulk of the audience may fall under this category. We move on to stage 3. This is what I call escalating your skills as a trader. Stage 3 is, I've been through it. I understand the huge risk role that risk plays in the equation. I now have good habits. I still have to think about every single step. This is called conscious competence. Conscious competence. This is, you're becoming competent, but you have to do it in a very logical, methodical, disciplined approach, as opposed to it being second nature, which is where we all want to end up being. Think of this like stage 3. Think of it as someone who's been driving for 6 months, is comfortable driving and, talking on their Bluetooth and having a conversation with someone in a car, as opposed to someone who just learned how to drive and has to pay attention to every little detail of driving. So stage 3 is we start to move processes from our logical mind to our subconscious mind, but still it is a process of keeping track of good habits. You still have to think about every step, and you have to focus on your reactions to trading. I'm slowly eliminating my errors, and it still seems like a long shot to me, but I'm sticking with it. I have a healthy respect for risk. I'm writing my pre-market expectations, which I'm pushing to kind of instill that in those who want to watch it by doing those trader bites that you see every morning at 8 a.m. Central, 9 Eastern. So if you go to my YouTube channel, you'll see these trader bites that are done every day. They've been going on for about 2 to 3 years. There's a whole bunch of them. And this is the process of pre-market prep and coming up with a plan for the day. So we go through the process of, you'll notice it's a very habitual, very routine, very repetitive process. And we end up with our hypotheses. These are our expectations for the day. So we outline what is the trade of the day, or the most likely play of the day. Then we go through the second most likely play of the day, and so on and so forth. That is the pre-market, writing the pre-market. I'm recording my performance and errors. So journaling is a big part of it. I know this stuff seems cliche, but it is absolutely necessary. I have to focus on the journey and about being deliberate with what I do when it comes to trading. I'm not focusing so much on, I made $200 yesterday, I lost $225 the day before that, therefore I'm down $25 plus fees and commissions. We're not keeping track in that sense. We're keeping track in terms of, and I really need you to kind of take this to heart, you're keeping track of how well you executed, how well you did versus what you said you will do is really where your focus has to be through stage 2 and 3 of your development. I've eliminated all distractions, and I have habits that give me energy and make me feel healthy outside of trading. So you need that balance. You need to be able to shut off trading at a certain point in the day and go focus on something else. This helps re-energize you for the work that has to be done to prepare for tomorrow, and so on and so forth. Let's keep moving. Stage 4 is where we all want to be. Stage 4 is when it becomes unconscious competence, meaning what you're doing, you're not even thinking about. Think of walking as an unconscious competent skill that you do. You don't think about lifting your leg, bending your knee, flexing your calf, setting your foot down on its heel, shifting your weight forward, and so on and so forth. You just get up and walk. This is stage 4. It's not so for a toddler who's learning how to walk, where they deliberately have to pick themselves up and balance and things. At stage 4, my habits at this point are involuntary. In other words, they're subconscious. I just do what I'm supposed to do without resistance. I don't know if I will make money today, but I expect to trade well. The market will do what it will do. This is really important. When I made the turn, and I made the turn about, 3 times in my career, where I went from just a disaster, not knowing what's going on, to actually coming in and expecting to do something with the market that day. It's really important to understand that, yes, we want to make money every time we click, absolutely. That's just our greed. But really, it is up to the market whether or not you make money. As long as you have an edge, as long as you have something that is studied and honed and has a probabilistic edge, you are likely to have days where the market is just not going to be in your favor. The market goes through cycles, and your plan is not likely to cover all of those cycles, or all of those cycles are not likely to be beneficial to your plan. So there are days where you follow your plan exactly and it just absolutely falls apart. And that's okay. That is not how we measure our performance. We measure our performance based on what we did, how we executed versus how we plan to execute. This is a really, really important thing that most people kind of fly over or brush over, that you cannot control whether or not you'll get paid. You can't. What you can control is what you will do relative to the action that we see in the market. Okay, so I don't know if I'll make money today, but I expect to trade well. This is an expectation that I have of myself at this stage. The market will do what it will do. I know I can fall back to stage 3 or even 2, but my focus on what has happened, my focus has to stay on what is happening now. So there are times when you are tired, there are times when things are going on in your personal life that are not in your favor, stresses, life changes, things like that, that are likely to cause you to get emotional, to lose sight of what your focus should be, and very quickly have us fall back to stage 3, where we need to then pick up the pieces and kind of be deliberate. And that's where a trading plan really is important. Something, even if it's on a bunch of Post-its, it doesn't matter. Something that brings you back to, okay, I'm back to my core. You will, even at stage 4, you will be revisiting stage 3 quite often, and possibly stage 2, as the market changes, as your life changes, as your focus changes. You're likely to fall into stage 2 and then work your way back to stage 3 and then 4. But the shift between these stages happens quite swiftly. And that's the reason I called stage 5 stage 5. It is called transcendent competence, which means you're at a level where you can operate at any, you can address and operate at any of those other stages and still have it be a meaningful conversation. I keep a flexible mindset and let the market tell me what it wants. I just respond to the market. I'm able to detach myself from the outcome of every trade. We don't want to experience drama on every single trade. It is exhausting. I've done that in the past. It's just not a way to have a career. It's very stressful and it's not rewarding at all. Does attitude make a difference? When vetting out and backing a trader, prop trader that I'm actually putting money up for, the key element that I'm really screening for is their attitude. Your attitude is everything. So, are you someone who makes excuses? Are you a victim of your circumstances? Oh, I didn't get this. Their dad is richer than mine, so they went to a better school, so they're smarter, so they trade better. The market is beating me up. The market hates me. The market's watching me. It's always something that is outside of ourselves. And as long as we're making excuses and things are outside of ourselves, we have somewhat of a fixed mindset. And generally, we don't have control. So we're actually allocating our control. And as traders, we always want to be in control of as much as possible. And there's so little that we control anyway. But one of the things I do not want to give up is my role in what is going on, because that is the only thing I can influence. I cannot influence the fact that I got short, Yellen started speaking, and she just ripped the market up 20 points. I cannot foresee that. My responsibility is to get out when I'm wrong, and that is it. But if I sit here and hold a trade that is short against a move that is pushed by the Fed, I can't sit here and blame Yellen for coming out and talking or whatever. It's my problem, and I prefer that it's my problem because then I can do something about it. I don't like it when it's someone else's problem or someone else's fault anyway, because I cannot control that. Do you believe that things only happen one way? So there are two mindsets out there, and there's a really good book on this. There's one called the fixed mindset. This is a belief that things are set. Things in life are really set. That there is such a thing as talent. Talent exists, and that who you are is not under your control. In other words, you were born this way. You were born not good at math. You were born not good with numbers. You were born rich or poor or of whatever race, and therefore you're disadvantaged or whatever. That's a fixed mindset. A growth mindset or a flexible mindset is one where you believe that you develop talent. So when you look at talented people like, Tiger Woods was, or Michael Jordan or whatever. What is overlooked is the fact that these guys absolutely lived and ate and slept and dreamed and woke up and ate some more of their sport, whether it's golfing or whatever. This is something they lived by. They were deliberate about it. They were coached through it. They made a very focused effort to becoming what they are. And we look at that, we look at the end product and we say, gosh, you know, Michael Jordan is so talented. Well, in trading, it's the same way. It is not really talent. It's what are you spending your time on? What are you committing to when you sit down in front of your computer and you quote unquote trade? This is what's important. How deliberate are you about your practice? And if you have a growth mindset, then you know that you can control, you can influence, you can change those aspects of your trading that are going to give you some positive returns, as opposed to just sitting there and going, you know, I have a small account and my internet sucks and blah, 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 and blah, 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 and this is why things aren't working for me. I will save you the trouble by saying you probably should go do something else, because there are no excuses when it comes to trading. I know that sounds harsh, but it's the truth, and trust me, I've backed people and I've heard all kinds of excuses, and I've given myself all kinds of excuses as well. So I was part of the problem, until I realized one day that I was running out of money, and unless I woke up and did what I needed to do, I was going to continue to lose every time I clicked, okay? So until you get to that point where you're just not able, your back's against the wall and you're not kidding yourself anymore, things just don't progress. And the difference is not that the circumstances change or the market changes and it's in your favor. The difference is that you take ownership of what's going on. You become much more responsible for what's going on, and that's the key to getting started. Does attitude make a difference? The key difference between what normal people can accomplish boils down to one thing, and I emphasize normal people. I'm assuming here that you don't have a learning disability or something that causes it to be difficult to learn. Some of us are disadvantaged, and it requires a lot more effort to overcome the obstacles that we don't even think about. So I emphasize the normal part because of this. I don't know who's in this audience, but the difference between us really is not the number of brain cells, neurons, or genetics or whatever. For this endeavor, it's really our attitude. It really boils down to that. Is the market really rigged? Are they after you? Is there an invisible hand that controls your destiny? Do you believe those things? I don't. I believe that I believe in karma. I believe that I do good and it helps everybody elevate everybody around me, and therefore it helps me continue to get elevated. But I don't believe that somebody's watching my trades and somebody's watching my account and somebody's shooting for my stops and things like that. I hear that a lot. I hear it from guys who are coming off the pit even on Twitter, and it's just so misleading. It just creates this fixed mindset that overall harms those who believe or buy into that train of thought. Any and all of these outside myself beliefs are obstacles to your growth. Your thoughts on fear and aggression. So these are important aspects of who you are. Fear is not a bad thing. Fear has kept you alive. Fear has resulted in your birth through your lineage, through your genetics and ancestry. Fear is necessary for you to be where you are, to be listening to me here. Otherwise, you'd be dead. Aggression is not a bad thing. On days when I see that I have an edge, when I see that the market's responding in a way that I expect, you better believe that I'm aggressive. I will rip into the market as much as I can while keeping an eye on risk. But aggression is a good thing. A lot of times you hear that, you know, aggressors are the problem, the culprit, the issue with our society. That's not true. You know, when you give someone on Wall Street an opportunity to short banks right before a collapse in the housing market, people look at those people as unpatriotic, or people who are vultures and pry on other people who went bankrupt and had to be foreclosed on. That is not how markets work. The market does not work with with compassion. Oh, let's not, otherwise everything will be inflated in its pricing. You have to have aggression. You have to have the opposite side pushing against growth when the time comes. And aggression could push, you know, in a rally or in a sell-off. I prefer it on a sell-off, but aggression is not a bad thing. Greed is not a bad thing. Without greed, we would still be rolling big wheel-shaped rocks down a hill to transport our food. You know, greed is what moves us to push the envelope. When greed doesn't exist, and this has been studied, when greed doesn't exist, there's generally a lack of urgency for development and reinvestment and growth. Greed has its limits, as does fear, as does aggression. None of your beliefs are good or bad. They just are. You know, take whatever you believe and just understand that it just is what it is. Just take it for what it is. Understand it. Accept it, accept yourself for who you are. And what does this have to do with your trading anyway? Why am I talking about this gibberish? Overall, all of us can create a plan and trade a plan and so on, but really when it comes to execution, when it comes to moving from a plan to execution to being successful, these things are what shape the outcome, in my opinion, of how things work out for you. Your beliefs dictate what kind of reactions you have to your trades. And most of us are raised with beliefs that are very limiting in many ways, very risk averse, and therefore these beliefs stand in our way. But you know, whatever you believe, you believe. Just the key element here is to be aware of it. Be aware that you tend to make excuses. You know, start there. The only way to make change is to start with awareness. Hi, my name is Futures Trader 71 and I'm an alcoholic, right? If I show up at an AA meeting, that's the first thing I have to do. I have to acknowledge and be aware of the problem. This is the first step towards change. So being aware of where you stand, being aware of the conversation that you're having internally is a key first step. And this is what I spend a lot of my time on, what I've spent a tremendous amount of time on with prop traders, just getting them to be aware of their reactions, of how they're responding to market events, of how they're thinking, so that they can start to recognize that and break the chain, break the cycle. You know, find that cue that pushes, that creates the habit, and then interrupt that cue. And the only way you could do that as a trader, in my opinion, is by awareness. It's all about the routine and process. I cannot tell you this enough. So I've given a routine on habits, given a webinar on habits on Futures.io. It's somewhere on YouTube. I talked about Charles Duhigg's book, The Power of Habit, and we did a giveaway. And so on. So I won't repeat that stuff here, but your routines and habits are really, really important. You know, like I said, if you look at the Trader Bite, and that's just a small fragment of my day, you'll see that there's this consistency, and whenever there's a change, that change is consistent throughout. You want to create as much consistency as possible, because ultimately to reach stage 4 as a trader, to become an expert trader, a professional, you need to start committing things to the subconscious. You need to not question the process that you're doing once you know that it works. And so being routine and process-oriented is a big part of that. We don't want to do too much thinking when we trade. We'll go over that in a little bit. Your ability to accomplish anything hinges on the quality and consistency of your routines. So here's a quick glimpse at my routine. So I'm just going to run through this really simple. I do this day in, day out from Monday through Friday. Wake up, morning routine, meditate. I would meditate for at least 20 minutes, if not an hour. Get your run or workout or whatever it is. At least do 10 minutes of stretching. Look online, a 10-minute morning stretch. Do that. It really changes things. down a lot of water in the morning. There's nothing more energizing than grabbing a good, liter and a half of Evian or whatever, and downing it. It starts this process and provides you with a lot of energy and focus. Get to the office, review the overnight action, news feeds. So I have multiple news feeds here. I use Trade the News for my main Squawk-based news feed. I look at their morning report and there are many products, Rand Squawk and many others, but my preference is Trade the News. In fact, you can get this product for about half price if you just reach out to me. I use Benzinga, I've used Rand Squawk, I've used Need to Know News, Bloomberg Terminal, whatever you have access to. Check out the news feeds, look for what is driving the market, prepare your hypotheses, and finalize the plan for the day. I start to do the Trader Bite at 8 a.m. Central. Again, this is a video that you can watch for free every day. It's streamed live in 1080, high definition, so you can see what's going on. You can follow the logic, and then you can follow what happens throughout the day, and I review what happened yesterday versus what was expected and why, and that sets up the routine for today, and so on and so forth, and it just repeats and repeats and repeats. Finalize your lines on your charts, your support resistance levels or areas that you're going to trade. I prepare my S5 book map here. Let's okay, so I prepare that, I put my levels on that. For those of you who don't know, this is an order flow product. It's a way to track liquidity. It's basically tape reading on steroids is what it is. Then when I'm done with the Trader Bite and I've got everything set up at about 8:20 Central, 9:20 Eastern, I shut off all sound, all the phones go into Do Not Disturb, and I close my eyes and I remind people in the chat room, in the S5 chat room, I remind them to just take 3 minutes of silence. So we've set up our day. We've done as much preparation as we need to do. It's really important. I mean, it sounds very frou-frou and hippie-ish or whatever, but if you do this for a period of time, you'll start to see some incredible changes in the way you think and your level of focus between meditation and the moment of silence before the open. And during this period of silence, you're just closing your eyes and you're letting your brain kind of clean up and process what was talked about during the Trader Bite, what you've seen in the pre-market, and just let things kind of settle in. It's an important part of the process for me. Just visualize how things are likely to open and look like. Focus on trading once the market opens. It's 8:30 Central, 9:30 Eastern until about 10:30 Central, 11:30 Eastern European close. Once the European close is done, generally the market goes into a little bit of a lull, and my focus switches to just doing my other responsibilities at stage 5 or whatever. And then I trade the end of the session. I trade the end of the day. Once that's done, I basically document the day. Here are the areas that were key. Here's an area where we had a massive liquidity collision that the market retested and held. That becomes a support or resistance level, and so on. I'm basically setting up my notes for that evening, actually. Once I'm done with this part of the routine, this is the trade execution routine here. Once I set up my hypotheses or my main plan for the day, I know what my biases are. I know what my key bias is based on how the market responds on the open. What is the opening swing? Where does it open? How does it respond when it opens? Sets up what the next key bias is. For example, today's key bias was the market is likely. So here's today. The expectation is the market is likely to test up. So here, the market's likely to open. It's likely to test up, and then take the overnight low, which it did, and then potentially start to move lower. That's the primary plan. That's what I'm looking for based on all the action that came before it. That was hypothesis number 1. Hypothesis number 2 is chop, open, test below, chop, chop, move up, break that 2026, 27 key resistance area, and then start to float up towards 40, 50, which is a very big area up here. That's the second hypothesis. My job when the market opens is to monitor that, to monitor which, I don't know which one the market is going to play, but if I show you here, as I replay today here, it's likely to give us a few hints. The white bands here, the time here is in GMT, so you subtract 5 hours for Eastern, 6 hours for Central Exchange Time. And as the market opens, this is 14:30 is 8:30 or 9:30. This is the open right here. The market starts to give us hints. What you see here, white, the very bright white bands are bands of liquidity. The orange circles are size hitting the bid. The size is set to 325 right now. So it doesn't show me anything that's below 325. It does count it, but it doesn't show it. So it could be a bunch of one lots or whatever. And then you see here the bounce at 2022. 2022 was yesterday's low. We have liquidity there. There's a bounce. I'm starting to pay attention. My expectation is either it takes out the overnight low and pushes higher, or pushes higher and takes out the overnight low, takes out yesterday's low, and continues lower. But so far, it's really testing. It tested yesterday's low, and it's really chopping around here in the middle, and it continues to do so. So this is basically telling me that the market does not have any direction on the open, so I need to stand back. I am not imposing what I expect. I'm not getting in here and saying, man, I think we go long today, and I just push to get long. I am waiting for the market to tell me who is in control. Who is in control? Early on, sellers came in control. Down to yesterday's low, 2022. We see size on the bid here. If it breaches that, then I'll start stalking short. If it does not, then I'm looking for areas where the market will pull back, and I will look to get long. So those are the basic trading techniques. Here's more liquidity that's come into the market right here and held up this the small pullback after a large rotation up. So those things I read in real time. I'm constantly reading this information in real time, and I'm actually executing on this platform right here. It allows me to, put OCOs out or whatever I want. I trade it right off this screen. So that's an example of what I'm looking at as far as execution. So back to what I was talking about. Look for what the market wants to accept as far as my hypothesis. Look for an area to lean on. Is there liquidity to lean on? Are there multiple levels to lean on, long or short? And then the last thing I look at is liquidity. My trades are based on what is happening in the auction. Hang on one second. My trades are based on what is happening in the auction. So I'm paying attention to how this auction is taking place. How is this profile forming here? What kind of trading do we have? What kind of low do we have? And so on and so forth. But on top of that, in order for me to execute, and I used to do this through the tape and through the dome strictly, on top of that, I'm looking for how liquidity is being treated. Is liquidity coming in and disappearing? Is liquidity being traded out? In other words, do we move towards a liquid price and then we see a big dot, meaning a lot of trades went off in that area and it pushes through, causing a short squeeze, and then it pulls back to it or whatever. I can't get into that right now. I will in future webinars. I can I can show you a very consistent kind of repetitive motion or pattern to the market that it can be exploited day in, day out. Let's speed this up quite a bit. You can see the size here on the offer coming in. That catches my interest. This it pushed through the 26, 27 area, and I'm looking for failure on the first try. And there's your failure right here, a lower high, and it's starting to rotate through this consolidation. So I'm expecting it to flow down, and so on and so forth. So, and if that doesn't happen, then I know that okay, there's a fair amount of strength, and I need to just be careful and watch for the long side only. And that's what we did today. There were a lot of cautions in the room, caution shorts that I sent out pretty much multiple times today, saying, look, it's not playing hypothesis number one, which is to test up and go down. It had tested down and is going up, and now our target becomes that 40-50 above. So that's just part of the execution routine. Before I enter, I set my targets and scale out so I get cued well, meaning get a good spot for my exits. I stalk the trade, I execute. Once I execute, my hands are off the mouse. And that's one of the key things that folks do wrong with their trading plan, is they try to manage their trade by staring at the dome and watching what is on the bid, what's on the offer, oh my God, this, and they start to convince themselves of why the trade doesn't work. They don't do that on sim, so everything looks great. But once they do it live, you'll find that if you listen carefully to the conversation you're having internally, that conversation will contain a whole heck of a lot of detractors from what you're doing in your plan, in your trade. As I indicated, I'm constantly managing what the market is offering as information. A simple example of that again, here's a bunch of liquidity that's been sitting here. The market pushes into it, doesn't trade much of it, it gets canceled, pulls back, pushes through it again, and so what you have here is what I call a weak local high. The expectation is it pulls back and busts through on the upside, and that's what it did. On a short-term chart, this looks like a multiple high, like right there. Multiple tops, expect it to pull back, and then eventually bust through, as you have weak highs all morning this morning, and you have a weak low, and the weak low looked good until this almost 7-point rotation up, which canceled that out, and things started to look more rosy for the bulls at that point today. So you're managing the information as the market generates it. We're not imposing our needs and thoughts and opinions on it. We're just looking for what is it confirming, what is it not. Once the trade is has tested or has failed to test the areas we expect, the trade is closed. Whether it's a stop or a loss exit or a gain exit, it doesn't matter. It is just one trade and an ocean full of trades. That's our goal, and you move on. I usually, once I close a trade, especially one for a loss, I generally move back in time. I go back in time, and I look for what was there that could have hinted to what was coming, what was going on. Oh, look at this delta. The delta's rising as this is sitting sideways. The delta's rising, and the delta's still valid because this is pretty early in the day still. It looks like buyers are really, lifting the market and looking for it to squeeze higher, and I want to be a part of that. So that's that. So I review the day so far and up to the point to where we stopped, and then I move on. This is my evening routine. The session ends. I trade the last hour. I go away. Do something else, usually meditate in the afternoon, then I come back in the evening at about 5 o'clock Central, 6 Eastern, and I update my charts. I go through a standard routine of looking at the big picture. So I look at my fundies chart here, the fundamentals chart. Here's the SPX, and look at what it's doing. I look at how the 52-week highs and lows are operating. I look for just macro type indications. Here are the 5 key sectors of the S&P 500. They represent over 75% of the S&P 500. Those are the healthcare, in this order it's healthcare, consumer discretionary, and then you have industrials, then you have techs, and you have financials. And I'm looking for those sectors, which one is the weakness, which one is the strength, and I'm looking for those sectors to be moving in the same fashion as the S&P 500. This is a macro view. The next step is to look at the bigger picture profile. What are we doing profile-wise? This is a monthly profile, one profile for every month. And I'm looking for what kind of behavior are we getting on the profile. Here we have February that traded inside of January. January was this long, elongated profile. February was stuck inside of it. And now March has broken higher through what January did, and so the strength is on the buy side, and we are now pushing into this high volume area, very thick area of the profile at 2040, which was the key level for today, and so I know that I get a big picture view of what the market's doing overall. Then I look at the daily. Let's fix the scale here. I look at the daily, and I look at how that daily is operating against the most recent auctions. What is it testing? What has it done? And so on and so forth. And I'm basically creating the pieces that go into next morning's Trader Bite. I end the session with 3 preliminary hypotheses. If it opens here, what am I expecting? If it opens above here, what am I expecting? If it opens below here, what am I expecting? And then I just disengage and shut off completely by 6 o'clock Central, 7 Eastern, and I just go spend time with the family or whatever. You need to disengage. It's very important to not trade, then do research. And the idea here, yes, there is hard work to be done, but the idea is working hard all the time is going to actually take away your focus from when you need to trade. Things look great until you click. So I did a Trader Wisdom session. If you go to my YouTube channel and look at the playlists, there's a Trader Wisdom Trade Wisdom session about this. Things are always fantastic, and all the plans that you make work until you actually do it live. In order to take care of this, in my opinion, you have to start by understanding that you have multiple states of consciousness. As a human being, you have multiple states of consciousness or multiple states of awareness. So under stress, your ability to be aware of what's going on really diminishes dramatically. This is scientifically proven. One of the greatest books that's out there about this is called The Chimp Paradox by Peters. You can grab that link right there, type it into your browser, it'll take you to that book. The 3 key remedies that I've come up with over time are: you should know that you cannot rely on your mind while under stress. What does that mean? It means that your effort right now should go into creating routines that relegate everything you do for trading into a subconscious state. In other words, your routine for executing a trade, you're going to want to make that as automatic as possible. So why is this relevant? Think of high-stress jobs like being a firefighter, policeman or woman, or in military training. In the military training or in police training, the whole idea is that when things happen, you should be relying on your training. You should not be thinking. In other words, if you're going to breach a door into a hostage situation at a school, for example, you can't sit there and do your thinking as you're breaching that door. All the thinking is done. That's why we do the pre-planning before the market opens. If you're one of these traders that comes into the market, waits for it to open and then says, I don't know, I'll see what it does and then I'll decide what I want to do. Trust me when I tell you this. Trust me. Even if it's working now, there will be a time when it won't work, and you're likely to be very, very lost when that happens. You want to do as much thinking as possible before the fact so that when the market opens, you're executing. period. That's all you're doing. Your entire focus is to execute. Much like I said, for the police or the military, you want to follow a repeated and well-honed routine. It doesn't matter what that routine is. You can trade the market in a billion different ways. None of it's, there is no special way to trade the market. Just make sure that what you're doing is something that is really deliberate and routine-based and repetitive and repetitive and repetitive and boring. This is really important. You should also know that your emotions are not to be controlled. The idea is not to sit there and try to control how you feel or whatever. The idea is to just be aware of it. Know that you're starting to get hot, or you're starting to get antsy, or you're starting to get nervous, and just tell yourself, I'm feeling stressed. I just need to stick to the job here. I need to stick to the plan. Just be aware of what's happening as opposed to just always responding. Think of anger management, right? If you respond to anger every time, there's likely to be a lot of unhappy people in your life, and you're likely going to be unhappy, and chances are you're just ignoring the problem. But if you're someone who's aware that you can get angry, you give yourself that moment, the 3 seconds it takes to take a very deep breath and to understand that you don't have to react to these emotions. You don't have to react, just be aware. Just follow the plan. If the market has not breached or has not told you that something has changed, then trust that the plan that got you into the trade is the one that is likely to work out best for you. Even if it's for a loss, it's likely to work out best for you over time. Of course, this assumes that you have an edge, and you have tested that edge, right? And you can test an edge with as simple as a journaled and calculated sim performance to show over time that you have an edge. You would penalize your exits on a simulator by 1 tick to make sure that they get filled on the market, and see how the performance is. If you follow your plan on a simulator and it gives you good results, and then you go live and you can't get those good results even though you've penalized your exits on a simulator, then the problem is you, right? The problem is that you're just not executing or seeing things. The routine is not in place yet in your mind. Recognize that there's no way around the fact, and I've said this almost in every Futures IO webinar, there's no way around the fact that the outcome of every trade is equal. It's a 50-50 chance. The outcome of every trade is a 50-50 chance. Get really cozy and comfortable with that fact. Even if your plan is supposedly 80% winners or whatever, chances are the next trade has an equal opportunity to gain or lose as part of that data set that gives you the 80% win rate. So you cannot control that. It's impossible. So we're almost there. Overcoming common execution issues. One of the key things you want to track are your errors. Again, this is a no-nonsense conversation about what you need to do. I know it's not fun. I'm not showing you some fancy indicator or anything like that. But this is the nuts and bolts that ultimately make a difference for your overall performance. If you find that you've skipped from one plan to the next and followed this guy and followed that guy, then got this indicator, then got this course, and you're still in the same place, you're still at stage 2, chances are you're not following at least some of these pointers that I'm giving you here. One of the key things you want to track is your errors. There are 6 classes of errors. The first one, these are the most common. The first one is not taking a planned trade. You just sit there and you wait and wait and wait for confirmation. The second error is interfering with trade management. You're micromanaging a trade. The market has done what you expect. You get it. You want to get short. You see a good opportunity to get short. It's backed up by your plan or whatever. You get short. Then the market gives you 2 ticks, then goes against you a point, goes against you, 5, 6 ticks. Then it goes back to scratch, and it gives you 2 more ticks, and you close it because you would rather take those 2 ticks than to wait for the plan to work out so you can get 16 ticks or whatever it is you plan to take. That's micromanaging a trade. The market has not told you anything that would lead you to believe that it has breached or it has violated your plan, yet you feel the need to exit or micromanage a trade. That's an error. Chasing a trade, the fear of missing out, it's a very, very strong impulse in us human beings, especially educated human beings, people who are used to being in control of their surroundings. FOMO is a formidable adversary. It's an error. Do not chase a trade. Take it where it belongs. Chasing a trade means your stop is now much farther away, and it means that you would have possibly inverted your risk-reward ratio on that particular trade. Technical execution errors, buying when you thought you would sell, selling when you thought you were going to buy. Those are technical errors. Allowing outside influences while you trade. You know, you're on a forum, or you're in a chat room, or you're with your buddies in a Skype group, and you got short. The market's telling you it is weak. You got short, but then one of the great traders in the room decides to get long, and you exit your short because, well, he or she is a better trader, so why shouldn't I listen, right? That's the error number 5. Also, taking a trade based on someone else's recommendation or plan is number 5. And number 6 is inadvertently executing a trade entry or exit. You're clicking on your screen, and all of a sudden you find yourself in a trade. Most people do not exit those trades. They try to scratch them, and a lot of times they result in a massive loss. So finally, 5 key details that require your attention. Most traders focus all of their attention on trading techniques. This is the biggest thing that most people spend their time on. It's important, but the real issue, in my experience, is executing on that plan. There isn't one superior way to trade. Move past this point quickly. Find something that makes sense to you, okay? And then do the homework for it, and then go get past it. Get past that. You don't need to keep digging and digging and digging for perfection. There is no perfection in trading. Ultimately, it is a 50-50 chance on the next trade. You cannot make it better. Pay attention to your attitude. As we had talked about, the conversation you're having in your mind is crucial. If you don't believe me, record yourself speaking out loud and listen over the weekend. Listen when you're in a different mindset. So turn on a mic. I've done this. I have done this a lot. Put a headset on and just talk your way through the day. Maybe the first hour of trading. Just talk it out loud. At first you're going to be guarded, but over time you're going to become honest. And if you listen to that conversation in a different time, maybe at the end of the day or on the weekend, you will be shocked at how often you use words that disempower you. Things like, oh, they took it away. This guy just ran the market. It's this disempowered, couldn't help it, and it gives you an idea. It gives you an honest look at what kind of mindset you have. Number 3, follow a simple but repeating routine. A simple but repeating routine. Make a habit of how you plan, prep, execute, manage a trade, and document it. It's like the military, like the police, like firefighters, like a person shooting a basketball from the free throw line. It is a repeating and involuntary response. This is where we want to get to. Trust me, this is where we want to go. We want to make the day-to-day stuff become a second nature thing that we don't think about. The more you think about what you're doing, the more likely your execution will take a hit, in my opinion. Number 4, test your edge until you can really trust it. Simply use a simulator for that. Penalize your exits. Keep good records. Once live, just let trades reach their own conclusion. The market's either going to pay you or it's not, and it's that simple. Number 5, this is a long process, okay? Settle into the fact that, no, you're not going to open a $5,000 account, even if it's with stage 5. You're not going to open a $5,000 account and expect to make $1 million a year. It can happen. I can't say that it can't. Stranger things have happened, but it can happen, but it's not likely. So settle into the fact that this cannot be rushed. You can't be on a strict timetable. You simply have to focus on the process. And the key thing that you control, that you have to manage, is to make sure that the time you spend in front of the computer is meaningful time, that it is deliberate, that you are working on lowering your error count, you're working on improving your expectancy, you're working on executing exactly the plan you laid out. You're working on some aspect. Think of Kobe Bryant showing up at 5:30 in the morning and just working on a jump shot from a particular part of the court because he feels that's where his weakness lies. Things like that, that you're coming in with a plan to do a very specific thing and to really focus on it. Don't focus on the outcome. Like you're just not there to focus on, oh man, I made $1,000 today. I should have made 100,000 if I had just multiplied my size. That's nonsense. It's wishful thinking. And when I log into our demo risk manager and look at all our demo accounts, there are people in there holding 1,200 lots in the ES and making, tens of millions of dollars. It's a waste of time to do that. You're not going to do that in real life. So don't waste your time on it. That's my advice. Your focus should be on the process, on honing the process, and then trust that as you follow the process and you keep your integrity to the plan, that the plan, which should have an edge, your plan will give you that outcome, will give you that edge over time. You just can't measure that edge over 3 trades before you change your plan. It's the old coin toss example. A fair coin has a 50-50 probability, but you're crazy if you think that you're going to get heads on 2 tosses or 3 tosses or 10 tosses 50% of the time. It's not going to happen. That the results are going to be skewed. Where are they going to reach that 50% mark? When you're reaching high populations, high number of repetitions, high number of trades. That's what we're after. We're looking to extend our trading account into as many trades as possible, and I'm not telling you that because I'm affiliated with a brokerage. I'm telling you that because that is what we did in prop. In prop, if you come in and you're not trading that day, we have a problem. You need to be working on gaining incremental pieces of experience, and it's not going to happen by you sitting there and watching the market and talking about it and pretending to be an expert verbally at it. You need to trade it. You need to make those errors, and you need to work those errors out. If you have questions about any of this material, and I recognize that it was a boatload of material, if you have questions on it, you can get a hold of me at futurestrader71.com and fill out the contact page. Myself or someone else will respond, or info@futurestrader71.com. Terry, that's all I had in case there are questions.
Okay, guys, you can start asking your questions in the question box, and I will start working through them. Okay. What platform were you using when you were doing your charts?
This is Investor RT by Linsoft. Just go to linsoft.com/FT71.
Okay.
And you can grab it from there. I think they have a trial, I'm not sure, but if you follow this link, then you would fall under a separate support group that is done especially for people who follow me in.
Okay.
So use that link if you can.
Is Bookmap a program that can be purchased, or is it part of your FT71 site?
Bookmap is a product that you can get. You can get it. You can go to Stage 5 Trading, trading.com. The site is being rebuilt, but you can go to Trading, S5 Bookmap, and if you get it, you can buy it directly from Bookmap themselves. The company is called Velux Pro, but if you do it through us, you're getting a 14-day real-time trial, but you're also getting a $250 discount on the lifetime license as opposed to getting it from them. So I'd encourage you to do that, but you can get it from them if you want. It's a product. It's a product that you can just buy.
Okay. Do you recommend staying flat before or during news releases?
The rule I have on that is, if you're in a trade and let's say it's more than a one lot, and you haven't taken any profit and the news is coming and it's too close to your entry, you would be smarter to just close the trade. It's a better thing to just close the trade. But what I do is, because I trade multiple lots, if I've secured my risk, in other words, I've taken off enough that my average is actually much, much farther away from where the market is, I will hold the trade depending on the news. If it's something like consumer confidence, new home sales, pending home sales, numbers that are considered medium tier, I hold through as long as I've got room on the trade, and room is a function of your account size. But if it's something that is tier 1, meaning non-farm payroll, FOMC, Yellen coming out, ECB, Chicago PMI, Michigan sentiment, those numbers I will go flat because essentially the day starts over right after that release. You have to look at the day as if it's starting over with this new information, because the market's repricing based on that information because it's significant information, okay? So you're smarter if you close the trade and just re-entered.
Okay. How do you determine an edge?
An edge to me is a simple, edge really means that you have an advantage, either an informational advantage or a technical advantage over others. And edge is simply having, identifying and trading an instance of something that is happening that is more likely to happen over another. I'll give you an edge. One that I actually showed the homework for on the forum in a prior webinar, the statistical edge of an overnight high, overnight low trade. If the market has, let me draw it in here. If the market is opening right here, and we have an overnight high that's up there, an overnight low that's down here, the probability that the overnight high or low is going to be taken out is somewhere in the realm of 98% probability. And again, I've shown you the statistics or the mathematics of how we come up with that. You can just find that video and watch it. And so now I see that, okay, the market opened somewhere in here. It opened in range. It tested lower. It came right to this overnight low but didn't breach it. And then all of a sudden it rips up, pulls back, and starts to trade above the midpoint of the day. That's an edge. This has a very, very high probability of continuing and breaking that overnight high. That's a simple edge. Edge could also be, monitoring delta, monitoring how much traded on the bid and offer in certain areas. Edge could be trading in low volume nodes given certain criteria. As long as you have a positive expectancy, meaning if you take your expectancy and it's more than the cost to trade, that's an edge, because you can size up and exploit that edge even if it's just a tick. So edge is a tough thing to talk about because it could be defined in so many different ways, and it could be just an informational advantage. The fact that you trade crude oil and crude oil's ripping up, yet you look at crude stocks and they're all just dragging bottom still. They're not moving up. That could be your edge. You could have a stock portfolio that you can participate in based on your crude trading. It's just something that is identifiable and repeatable that gives you a positive outcome. That's basically the core definition of an edge.
Okay. Can you comment on using VIX to trade?
I used to have the VIX actually down here on my charts, and I removed it. if your time frame is intraday, I would debate that. I would have a good point to debate with you as to its usefulness. Based on how it's calculated and how it's built, you're likely not going to see a timely description of what's happening using the VIX. But if you're someone who's looking over 2-3 days or higher, the VIX is something that could help you figure out how the market, is insuring itself or how it's skewing itself when it comes to premium. So I don't use the VIX anymore. I don't look at it because I find that it's just not. I've had it for so many years, and it's something I've never looked at. And when I do, it's like, oh, the VIX is dropping. But then I look at the market, and it's already trending up, So if you test it, you'll see that, or at least I did, you'll see that it doesn't really give me anything except to say, oh yeah, okay, the market's rallied and the VIX has dropped. It's not very helpful to me. Yeah. The thing that's more helpful is something like the S&P breadth. The breadth, the advancers minus decliners in the S&P on the 500 stocks alone is more useful to me on days where the market opens and it's just right up against that 400 to 450 negative, and the market is, you see that the ES is having a hard time pushing lower, and you see the breadth starting to move up. Oftentimes I see that breadth is actually pushing before that the stock baskets start buying before the S&P responds. It's not often that happens, but it does give me a visual, and I do keep that chart open to a 5-minute to just keep track of what the overall 500 stocks are doing in the S&P 500.
Okay. In which platform do you execute your trades?
I use the S5 Trader. So I have it open, but in general, I'm executing right on here. This basically gives me everything I need to be able to execute. I can place trades. I can set set stops. I can set targets. I can make them into an OCO. I can shift these orders all I want. I can change my size. I can cancel. It's extremely stable and has been very, very good to trade right off of. So I've used the S5 Bookmap. More recently, I've been using the S5 Bookmap directly, but I always have my S5 Trader platform, which is the Gain or OEC platform. I've always used that. I've used that for a long time. Before that, I used CTS, and before that, I used Xtrader. But I don't see the point in paying so much money. I find those platforms not superior in stability anyway. I used to pay close to $1,700 a month, and still have them, freeze and crash and whatnot. So this is a free platform, and that's my preference.
I'm an OEC guy, so I prefer it as well.
Good.
Someone asked, what is the difference between trading a 2K account and a 10K account, psychologically speaking?
So the answer to that is a function of a lot of things. A 2K account, if you're trading, say, the micro FX, I would say that's doable. It's a great way to trade live in the market and and learn. But if you're taking a 2K account and you're trading the ES with it, or the NQ or crude oil, I would say that your risk of ruin is exponential. It really is. You're trading for less than what the exchange margin is, and chances are you're way over levered, and you're using $500 margins or whatever, which I despise. I think this industry is destroying itself with $500 margins, but it's your job is to really take as many trades as you can and stretch that account as much as possible.
Yeah.
So So if you were trading for me and I put up 25 grand and over time you're just making all efforts, and over time you took, 5,000 trades with the $25,000 and you just whittled it down to nothing, I would say, nice try. It was great having you. Sorry, I'm going to have to let you go, but I'm going to be very happy with your effort. If I put up 25,000 and you go and rip it apart in 20 trades, I'm going to be pissed because I want you to take as many samples as possible to realize your edge. And you cannot do that with a $2,000 account. You just cannot, unless you're trading a very, very small product, which is fine.
Yeah.
And that's the difference, really, because your risk per trade is going to be extremely high on a $2,000 account.
Exactly.
It really is.
And I would even say with a 10K account in futures is ridiculous.
Yeah, I used to always tell people 25,000 is a good starting point, is a good practice account.
Yeah.
But I recognized that I was speaking to a very, very small segment of the online trading population, so people just cannot commit that much to an account. We at Stage 5 we look for 10K. They'll do a lot less. They'll do 5K or whatever, depending on what you want to trade. But it's the margin leverage is really where you could get yourself in trouble.
Yeah, I think at that point you're better just buying the ETF and enjoying your life.
Exactly. Just put them in a Vanguard mutual fund or something.
All right. How do you manage the psychological damage inflicted by a big loss in the past?
So I think I might have done a talk on that. It's the biggest thing we want to avoid. You really want to avoid creating a massive emotional capital debit, so to speak. That's psychological speak, because if you allow yourself to take a trade that was supposed to cost you $300 on a stop, and all of a sudden this trade has just cost you $9 grand, yes, the money's gone. Yes, there's disappointment. Yes, you want to throw up. The biggest part, though, the thing that is unrecoverable, just like it is in a romantic relationship, is the trust. You have just betrayed your trust in yourself. How could you trust yourself to take a stop in the future when this happens if you weren't able to do it then? You don't want to mess with that trust. You want to maintain integrity to your plan. It's really a very, very important piece. So the first thing you got to do when you have that disaster is take the next day off. Hopefully it didn't happen on a Friday, because those are the worst. You end up with a terrible weekend. But you have to take the next trading day off. Generally, we like to lock the account for our traders who do that. We like to lock their account and just basically ask them to get back to us and say what they're going to do different to prevent this. So at least when you took that big loss, you paid for something. It's tuition for something. As opposed to someone who takes a big loss, shows up the next day, and tries twice as hard to make it back. All you do is dig yourself. The chances are, in my experience, 9 times out of 10, you're going to dig a bigger hole. It's better to just stop and figure out what happened, why you didn't follow your plan, and what you're going to do different. And then, if needed, fall back on reestablishing your edge, fall back on looking at your plan, fall back on simulating even, fall back on tossing coins. Whatever it is that caused you to be married to that trade, that thing has to be eliminated. It has to go away, because it's just, that's a very tough thing to recover from, and I hate seeing people do that.
Yeah. You can always make more money. You can always get more money. You can always refund an account. But your emotional capital, when it's spent,
it's tough to recover. Yeah, you're dealing with trust. Yeah. So that's a big issue.
All right. Do you have a PDF or a PowerPoint, any slides that you can send me so I can post on Futures.io?
Sure.
Okay. Someone was asking, so I will run that in the thread later after the webinar.
I'll run those off and shoot them over to you right away.
All right, sounds good. Do you have any advice on how to trade volume profile? Is there any way to practice in sim?
First, you need to have a charting package that gives you an accurate profile, right? So that's going to be a key thing. And I know many packages now. When I came when I started to work on creating this profiling stuff, this volume profiling stuff, there was really nothing out there that gave me what I wanted. And now there are more and more packages that have volume profiling. The thing is that your data has to be pretty good. Your data cannot be aggregated. It cannot be inaccurate. A lot of data feeds just lump trades, and so the profile doesn't show what should happen. Here, for example, I use IQ Feed, which is very accurate tick data. If not, the S5 Trader gives tick data, and then people use DTNMA or for backfill or whatever. But first you have to get something, you have to have a charting package that gives you good profiles. The second thing you could do is go to my website. Here it is. Just go to my website and go to resources, go to the video archive, and look at the old videos. I go through the step-by-step process of how I establish a plan and so on. So go way back in time. I don't like this format in particular, but it's the cheap way to kind of have a look at it. If not, you can always get these webinars. There's a link in here somewhere, I think it's on the main page, where you can contribute to one or more or the whole series, and it kind of gives you a shortcut. Here it is. It gives you a shortcut on how to get this process going. What are the basics? It goes through and these are older webinars, but the information has not changed. That's all I can advise you to do. And then also maybe look in the book section. There's a couple there are a couple books that are under resources that are recommended for that. But really, it's all about what is the data, what's the quality of the data you're working with, and then from there, it's just understanding some very simple concepts.
Okay. Let's see. Okay, they're asking, what would you need to see to hold your trade past your 4 to 6 ticks? How do you identify a trend day early?
Okay, so let me pull this up. I'll try to explain this very briefly. This could get really detailed. So let's say we took a pullback long, right? Let's say right here. So the market has consolidated. It's formed a zipper, which is what my term for consolidation, a short-term consolidation, and it has pulled back right here. And now you're looking for the rotation up. You might have gotten long here. The way I'm holding this trade is, one, I scale out within the 8-tick range. So I'm looking for a scale, and my goal with that scale out is to take the average, my entry, and to improve it and to have it drop away from where the market is to give me room. So I'm using profits on a portion of the trade to fund or finance the trade. Now I'm watching for what does it do as it trades. If the market starts to flag down and is failing, then I will just get out and take another stab if I have to. However, if the market is instead pulling back and it starts to push forward, let's say it pulls back and starts to push forward, then I start to, instead of watching the stop, which is down here, I start to watch what does it do with this zipper here. And I'll sometimes draw a profile around it. And my first warning shot is breaking through this consolidation after it breaks higher. So I'm using every consolidation as the test area. So if this pushes through, then it comes back and then it starts to fail, I will take something off, hold on, and if it fails through the second, I will exit and book what I have. So I don't use trailing stops, I don't use volatility stops, I don't use anything that's automated. I don't like to use anything that's automated, not because I haven't tried it, I have. I just find that as soon as I automate the process or kind of relegate that responsibility to an automated process, I find that I become passive and I'm no longer involved with the trade, and I don't like that at all. I prefer to just stay engaged with what it does as it's moving along, as it's developing. What is it doing on a periodic basis? So as as it fails through or as it pushes through, does it pull back and hold support? If it doesn't hold support, that's a warning shot. There's no reason for me to sit there and wait for it to hit a hard stop, much lower if I'm long. I'm going to stay active into managing this trade. So that's how that, and I don't shoot for a trend, by the way. I'm looking to average. My goal, my career is built on taking an average of 8 ticks per contract per trade, period. I can build an amazing career doing that. So if I can have an average that is just 8 ticks per trade, this is an incredible expectancy, and if you can size up, if you can maintain that expectancy while sizing up to 12, 24, 36, 48 contracts or however your account grows, those are pretty good paydays. It's a humbling experience to be able to just pull off something that seems so modest but is actually fairly difficult to do. Yeah. So I don't go for trends. If a trend to me is a birthday gift, I don't shoot for trends because I don't know when that's going to happen. I don't know, I don't have any idea what Yellen's going to say to cause this move. I expect most days to be balance days because my statistics show that somewhere around 78 to 82% of days in the ES are balancing days. So why am I shooting for trends? I'm going to play the higher probability, which is to play for balance. But I always keep a runner on, so I keep a small portion of the trade, an eighth, quarter, or an eighth, in case it starts to run from balance to imbalance. But I don't count on it, and I'm not the guy who's going to come on to a chat room and say, oh, I got long at 22 today, and it was awesome, and I caught it all the way up to 50. I can't make a career out of that. It'll be a nice little pat on my back, but that's not my business. That's not my trading career. My trading career is to take small nibbles, just get to the next base. I'm not looking for home runs, period.
Okay. To kind of dovetail with that, do you have any plans for adding to those runners if you get a trend?
Man, unrelenting details. I do, and I call that campaigning. Okay. I do make a very strong effort at trading around the position. I'm constantly looking to trade around the position. I'm looking to improve my average, and I'm looking to increase my position as the market moves. But remember, most of the time, this product does not trend. It would be different if I was in crude oil, but in the ES, I'm not counting on a trend, so I don't invest too much into adding to a trade or whatever. And even if I do, I'm adding in a scalping fashion, not to add and hold, not to double the position and hold it,
Okay. All right, let's change the subject here. What would be the best way of working through fear of missing out?
So it goes back to basically the same things that we talked about here. It goes back to figuring out how often it really happens, right? So you need to document the instance of it. And it's the same issue as always. You need to routinize, if there's such a word. You need to make a habit out of what you're doing. The fear of missing out is overthinking. The people who have a problem with FOMO really are intellectuals. They're not people who jump head first, right? So what you're doing with FOMO is you're waiting for confirmation, then you're waiting for confirmation on confirmation, then you're looking for this to happen, and you're looking for that to happen, and all of a sudden it's moved 5 points away. And now you're chasing it or you're fading it, which is very common. So you can't wait too long. What you need to know is that the market has failed. Like, I'll give you an example. The primary hypothesis, push higher, test lower. I faded this move here. I looked for a short, and I faded this move down. It worked for a couple points. I don't know that this is what's going to happen next, but all I need to see is that it's pushing into the closing swing. It's pushing into a key area area I talked about during the trader bite, which is 26.27. It stopped at 26.75. So I can't overthink it. Just take it. And when we look at the day on Bookmap, when we look at that point in time, it's actually got to load here. When we look at that point in time, we see that there's a fair amount of liquidity in that 25 to 28 area that I can lean against. That's all I need to know. It's kind of like being president of the United States in the case of an emergency. You can't sit there and see, let's wait to see what the Chinese do. Let's wait to see what the Russians do. You kind of take 2, 3 important inputs and make a decision and live or die by it. And trading is the same, except you want to base that on some statistical probability as much as possible. It's not always possible. You have to rely on intuition a lot. But if you sit there and wait for 6, 7, 8, 9, 10 inputs, it's too late. The market has already moved too far away. That's called price risk. You're taking price risk for more information. I would rather take information risk for a better price. In the long run, I believe that that's going to give me a better return. So the longer I wait, the more information I'm going to get, the worse price I have. And that then results in FOMO. So just simplify. Don't overthink it. Do your thinking before and just tell yourself, and go to a simulator if you have to. Tell yourself, look, if it does this, this is what I'm doing, period. I'm not going to overthink this. And see how things play out on sim. You know, penalize your offers or bids to exit, your limit orders, penalize them by a tick so that you know that the market had to trade through your intended target, and see how it performs. You know, be serious about it and see how it performs, and that should give you the confidence to just put the trade on. Ultimately, the people who make money trading don't sit there and wait for information, because by the time you get all the information you need, there are way too many competitors that have already taken their position and moved the market away from you.
Yeah. How can one recognize a flawed process as opposed to just a bad string of trades?
So there's this probability sequence, right? So there's an equation in mathematics that says that the outcome of every trade is 50%, okay? So it's 0.5 to the power of how many ever repeats there are. Generally, if I try to do something, if I try to get short, let's say I got short here and I got stopped. I got short here and I got stopped. And I got short here and I got stopped. I stopped getting short because for this equation to work, so this would be 0.5 to the power of 3. It basically mathematically means, let's do our little calculator here. It basically mathematically means that my probability, 0.5 to the power of 3, there's a 12.5% probability that I'm going to hit 3 losses in a row. That's a pretty crappy probability. I should probably back off. And so generally when I see that I come in, I lose money. The next day I come in and lose money. And this is after I've made the turn and I have a good read on the market and I'm just running through a rough patch. Generally, you know, I let either the number of repetitions or the amount of losses, my daily loss limit, dictate whether or not it's just I'm wacky or the market's wacky or it's a bad streak. The thing is, ever since I went from scalping for ticks, either trading equities and then going to futures, ever since I've left that and have looked at the market as an auction and I've just focused on reading the auction, that sort of thing doesn't happen. The auction kind of, it acts goofy sometimes like it did today. You just can't predict what people will say. But in general, the market follows some pretty logical kind of behaviors that you can exploit. The market has memory, and I generally don't sit there and have 3, 4, 5, 6 days in a row where I'm losing. Like something's got to be really, really wrong with me for that to happen. If you believe that what you're doing is based in fact and is based on sound logic, and all of a sudden you're running into a losing streak, then it's best to just stop. And generally, 3-strike rule gets me out for a trade. A 3-day loss rule stops me for the week. And knock on wood, I've never had a 3-week losing streak since I made the turn back in 2002. But something's seriously wrong for me to keep taking loss after loss after loss when the probabilities say that's pretty remote that should happen. Things go wrong randomly. Trades, I take losses randomly, but in general, when it's repeating, something's wrong, and I start off by taking a break. But if your system is, if your approach is systematic, based on some back-tested data and moving averages and floor pivots or some trading system, I can't comment on that because I don't have any expertise on that. I don't know that you can, it's possible to just lose your edge overnight in a system-based, indicator-based system.
Yeah.
But in the auction itself, the auction has been here for as long as human beings have been trading things. It's the same process again and again and again, and that's why, I switched from trading 3,000 round turns a day to doing what I've been doing for the last 10 years with volume profiling and so on, because the auction makes sense to me. You can layer indicators and things on top of that, but just understand that the market's constantly seeking balance. It's constantly trying to, its goal is to constantly get as many traders to trade at the most accepted price possible. That's why we have malls, that's why we have supermarkets, that's why we have auctions. We're getting as many buyers and sellers to come and meet and find that favorable price given interest rates, earnings, Fed disposition, ECB disposition, what geopolitical news. That's the purpose of the market. So when the market moves like this, it is repricing risk. That's all it's doing. It's looking, it's saying, okay, the prices down here are no longer fair, so buy until we find sellers, and we'll keep going higher until we find sellers. We're advertising higher prices. That logic is very easy to follow. You just have to watch it enough. And that's what I've dedicated the last, 6 years or 7 years that I've been talking to the public, to just get a grasp on that. And then you can throw on your fibs and Elliott and whatever else you want, just as long as you understand the base of what moves the market. And under those circumstances, I've not run into, wow, I can't do anything right, because I can see what it's doing based on the auction process. I don't know. It's a hard one to answer.
Yeah. I see that your volume bars have historical ranges on them in your investor RT charts. Can you share that study?
Which I'm not sure what that means. Historical ranges?
Oh yeah, on your volume bars.
Oh, this. Yeah, that's a 20-day average. So the yellow is where the last 20 days, the 20-day average at that particular time slot.
Okay.
So you could see here, normally during this hour of the day, we would trade in this, because it's a 15-minute bar chart right now, and if I switch it, it'll just give me what it is for that time period. Normally we would have traded 32,000 contracts. Today we traded almost 99,000 because of Yellen. So you could see that volume was kind of in line. Mostly, it's a little bit light, but mostly in line today until the Fed came out, and then all of a sudden the actual volume was pretty much higher than the 20-day average volume. This definition can be found. Just shoot me a message, futurestrader71.com/contact, futurestrader71.com/contact, and I'll get you the chart definition for this.
Okay. Do you recommend using time, tick, or range charts?
So I don't like time, and the reason I use a 15-minute chart here is because It provides that, if you've ever been to the pit, and I'm a member of the exchange, there's a siren that goes off every 15 minutes. If you've ever listened to the S&P squawk, you'll hear it in the background, doo, 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 every 15 minutes. It means submit your trading cards. It tells everybody to turn in their cards. And so a 15-minute time slot is a natural thing, even though I never traded on the floor. It's just something that I've carried over time. But the 15-minute period allows me to look back very quickly. Okay, but I really don't like time, because time is irrelevant except for when the market opens, when the market closes, and when economic figures come out. Otherwise, time is irrelevant to the auction. And so I don't pay attention to time too much. I'm paying more attention to what the volume is doing over time and where the market's trading relative to the most recent volume. I trade when I'm triggering. This is why this chart's called the ES intraday trigger chart. I'm triggering off of a 2-tick Renko, and I use a Renko because it shows me the trend more cleanly, and more importantly, it shows me these zippers more cleanly. It shows me where the consolidations are, and I use those to manage trades. These little consolidations where the market flags for a short period of time, but really, you know, volume bars, tick bars, P&F charts. I think those are all good. It's a preference. It's like, do you like red wine or white wine? Do you like a Chardonnay versus a Merlot versus? It's just a matter of taste. You know,
Yeah.
what feels good to you. Just go with what feels good to you. Try to minimize the amount of conflict and learning you have to do from day in, day out when it comes to your charts and so on. Focus more on what the market is doing and how you're feeling about trading. That's where your focus should be, in my opinion.
Okay. I'm just going to take this moment to ask you how much more time you have. We still have probably 30 or 40 questions.
Holy cow. Oh, man. I was hoping to keep this under an hour and a half.
We're about that, or a little over that, so that's why I wanted to take a moment to see.
I do have a commitment in about 6 minutes.
Okay.
I didn't expect us to go that long, but let's try to hit as many as we can while we have them.
Okay, let's see. Maximum effective number of hours to trade in a day.
Okay, so it depends on the product, but in general, okay. I actually did a study on this. This is how just disturbed I am about trading, but I actually did a study on this with my prop guys. If you're someone who's taking regular breaks, so if you're someone who's getting up off your desk, and especially if you have one of those standing desks, I have a standing desk at home. I love the thing. I can go on for a while because a standing desk forces me to take breaks. It just gets tiring to stand there.
Yeah.
It's a function of how much do you break up the time. But realistically, depending on the product you trade, realistically, you'll start to recognize over time that your greatest opportunities, the general habit of the market volume is to have this sort of a curve. It is high up till the European close, which is right here, and then it goes dead, goes flat until about the closing range trade, which is between 3:20 to 4 p.m., where volume comes back in and the market makes a deliberate move. Today is special because of the Fed announcement, but if you look back through time and look at these average bars, look at these yellow bars, that tells you what it's done over the last 20 days at each time slot. And look at how it always breaks down and then it picks back up. It's doing that every single day. Trading in this stuff here, I remember I had 3 guys who loved trading that period. They would make markets and bid and offer, you know, dozens of contracts in the DAX or whatever here and there, and they're just looking for the ping pong. And they made good money doing that unless the market ripped. If that's your style, fine. But in general, I find that most people just should be focusing at about 15 minutes after the open, 15 minutes, a half hour after the open, then start looking to trade once the market has established its opening swing, and do that through 11:30, 12 o'clock Eastern, and then just go away, go work out, go for a walk, go make lunch, whatever. Come back in the 3 o'clock to 4 o'clock time range where you can actually, there is some movement, clean movement that you can work off of. I find that showing up at 4 a.m. and trading all the way through to 4 p.m. it's just, I don't know that you're getting that many opportunities, and the return for your time is not likely to be great. It's kind of like a person who goes to the gym and just hangs out there for 7 hours a day. They want to be a bodybuilder, but they're just, instead of someone who just comes in fresh, does their workout, hits it really hard, really deliberate, and then just moves on to the next thing. That's the difference. I don't know if that makes sense, but you want to minimize the amount of exposure you have, amount of time you're exposing yourself to the market, because you want to maintain balance. Otherwise, you're going to burn out. Trust me, the market trading can really take it out of you. So I don't know how much you want to spend, but it depends on the person. It depends on the product. Try to make it so that it is that time that gives you your edge. And I can almost assure you that there is nobody who has an edge 24 hours a day. It just doesn't work that way in most cases.
Do you find yourself watching Bookmap more than your charts?
No, because I base my trades on my plan, and my plan is on my charts. I'm looking at the overall auction. Bookmap really comes into play, and I think they're doing a webinar for you guys here soon. Really only comes into play when I'm stalking trades. I'm only looking at Bookmap when I'm looking to read what the most recent action is. What can I lean on? What's been here a while? What liquidity's been here a while? Is it canceling as the market's moving up to it? If I'm looking to get short in the 47 area, okay, I have some liquidity at 48. What does it do as the market approaches? If it stays steady and it trades and it's not moving, it's actually trading out, that gives me a better opportunity or more confidence to hit the bid on that short and take the trade. But it's not something I create trades off of. Although I'm going to tell you that if I had this when I was doing scalping as a prop shop, I think we would have done much better as a group, because we used to visualize this, and we used to keep track, mental notes as to where liquidity was, when did it get lifted, how did it behave when it was there, and it's a lot of stuff to keep in mind, but over time you learn to do that. So I don't watch it all day long. I just focus on it. I focus on it once I'm ready to take the trade, once I've established that there's an edge there.
Okay. On your 5 key details, you said penalize your exits on number 4. What does that mean?
Let's look at that. So let's say that you're using a simulator to test your edge, and you're taking an exit. Let's say you got long. Let's say you got long 2040, and you're looking to get out at 2045. That's what your plan says. Okay. If you're doing it on a simulator, chances are as soon as 2045 gets touched, it'll fill you. On most platforms, TradeStation, Ninja, all these platforms fill you immediately. That's not realistic. You cannot base your trading plan or probabilities on that, or statistics, trading metrics on that. So what you have to do is, unless it's a market order, you need to put your order in the platform at 2045 and a quarter. Why? Because you want to make sure that it trades through your exit that you want live, to record that trade. So basically you're penalizing your trade by a tick. And I don't mean doing it, getting out of 2045 and then reducing it by a tick, reducing your exit by a tick. No, I'm talking about assuming that the market has to trade through your exit, your intended exit, for you to get filled. Why? Because when you go live, the market doesn't fill you as soon as it touches that price. It'll sit there and it'll nibble through a couple of hundred, 300, 400 before you get filled. And it really changes the results dramatically. You're talking about $12.50 per trade per contract that you're going to lose if you don't account for it, and that's a whole tick. That's a lot, you know, for someone who's trading short term.
Yeah.
So you want to, you know, but if it's a market exit, like your stops do not need to be penalized because they're executed at market, and they would be executed at market in a simulator as well as live. But if they're limit orders, you need to, if it's a short, you need to bid a price one tick below your intended exit if you had been trading live. And if it's a long and you want to sell, you need to sell one tick higher than your intended price.
Okay.
And that gives you, that makes your expectancy more closely tied to what it would really be in real life.
Okay. I have 3 more questions, and then we're going to wrap it up.
Sure.
The first one is, in your last couple trader bites, you mentioned over-under. What exactly does over-under mean?
So this is basically an area where the market is likely to battle it out, and if it's able to overcome that price. So a very clear one is this 95.50. So if you look at this chart here, this is a 15-minute. The market pushed to 98.25, came back, pushed to 95.25, dropped down, pushed to 95.50, dropped down. Then we gap way the heck up, test 95.50, and then push way up to 2015, then come down to 95. This becomes a classic support resistance line. Essentially, the market is battling this area. And we see this across multiple days. So you can see this here, you know, from the beginning of March all the way through to the 16th. So it's happened over several days. That same concept exists intraday. So it's just a different fractal, so to speak. So if we go intraday and we look at, actually, and the most recent instance happens overnight. So here's one that came in for today. So you see how the market basically opened, tested up, pulled back, tested up, pulled back, and then it broke through, and it pulled back here, and then it stayed down below. What it created is this low volume node. You see this in between these two. In fact, you know, this basically shows that the market has accepted this area for a period of time and traded a lot there. Then it moved and accepted this area for a period of time and traded a fair amount there. And it left this area in between where there's very little trading that occurred. This is where the 26, 27 over-under line comes in for today. So
okay.
I know that if it slips through this low volume node, pulls back and breaks through, chances are it'll pull back and it'll test this high volume node. This is a very typical auction behavior. We move through the low volume node and test the next high volume node. Then we push through to the next volume node, low volume. And notice that the breakout this morning, notice how right here there was very little volume before we broke out. This is carried over from here, from the overnight session. Also, 2026 comes from a weekly chart. So that becomes a pivot point. The more the market tests and retests and fails at a certain area, the more and more it becomes a key pivot area, and it's something that we pay attention to. That's where that comes from. Hang on, it's right here. So here it is, the 2026 again, right there from 2 weeks ago. And I talked about it all week last week. We opened here and I said it's likely to test this 2026. It left this low volume area behind, and it basically tested it on Wednesday by a few ticks. And then the next day we opened and we broke lower, and then we balanced out and we ended up pushing higher. And so this becomes, this 2026 75.27 has been carried for a couple of weeks. That's why we call it a key pivot. The way you discover those is just by watching what the market does kind of day in, day out. And you see that it reacts differently at certain levels, and those levels become subtle levels that you need to keep track of. Right now, 95.50, 96, 2026, 27 is a key area. And then above us, 2064 is another one. And you just kind of remember these things over time as you watch the market trade.
Okay, I'm going to end it with this last one. Can you explain what a zipper is? There's some non-English speakers and they're wanting to know. Yeah.
So a zipper is something, if you don't know what that is, it's something that's something that is in your jacket, in the front of your jacket, you know, a zipper. It looks like this, and you close your jacket and you zip things up, and the way it looks like is it makes these tracks that look like this once you've zipped something up, like a purse, jacket, whatever. That's a zipper for those who don't speak English natively. Okay, the market does the same pattern. You'll see it right here. You see that? It just does this up, down, up, down. And what the market is doing when it's doing that is it's consolidating. It is coiling. And the market tends to go from a coil to imbalance, to a coil, fall back, or continue higher, imbalance, coil, imbalance. That's the nature of the market. So take a stock, take a currency pair, take whatever. Go back to any random day. Let's go to any random day. Here, I'm just going to move back to a random day. There it is. It's the same thing. We have what's called an impulsive move, 9 points, pull back, zipper. Continuation move, pull back. Then we have a higher low for corrective, corrects, and then all of a sudden goes into a zipper. And then if you're in a higher time frame, you would be seeing this whole area as a zipper. In a short time frame, you can see the little ones inside. But on a higher time frame, they occur, you know, everything that occurs in a small time frame in the market occurs in a higher time frame. It's just the nature of the market. But I can show you the same thing where the market consolidates, then it compresses, and every time a zipper happens, the expectation is that it's likely to break. So here's a zipper on the 15 minutes, there's your break. Here's a zipper on the 15 minutes, there's your break. And then it zippers, then it breaks. The market cannot sprint without resting. In most cases, it is very difficult to commit a lot of money to a market that's already run 50, 60 points and just keep pushing. It tends to take a break. People tend to take profits, and that's what creates that back and forth before the next move. So the nature of an auction is we create volume, then, and in that there's some sort of a zipper, right? We create high volume, then we break. So a lot of this volume, a lot of this energy dissipates for those who are into physics. We consolidate, then we break away. We use this energy in a consolidation because for every buyer, there's a seller in futures. There are never more buyers than sellers. Then it breaks, and once it breaks, it starts to advertise prices higher and higher and higher to entice sellers. If I'm looking to sell my iPad and, you know, and there's a huge demand, what I'm going to do is keep raising prices until I find that nobody's interested. And at that point, my prices cannot go up, and they consolidate, and they sit there. And as they consolidate, I sell a whole lot of them. But then if all of a sudden Apple produces a new iPad, a new type of iPad, an upgrade, all of a sudden the price drops. This selling and buying entices people to act as soon as the price drops or the price breaks higher. So all the sellers then, short sellers then get squeezed, or all of the folks that had bought it and expected to go higher get squeezed the other way. So whenever you see a zipper, generally that becomes an area of a pullback. I can't show you that now because I don't want to rewind Bookmap and show you that, but in general, you'll see that on Bookmap you'll have a zipper. Actually, I may be able to do that. Let's clear this up. We would have a breakout, and very, very often, especially if there's a collision like here, and very, very often what will happen is it'll go up, it'll collide with liquidity. This white line, see this big dot, means somebody lifted a lot of volume there, and then it would rest, then it would continue, and what does it do? It generally comes back to that consolidation, to that zipper. It generally comes back to the zipper before it makes its next leg. Then it rests, and if it continues higher, then it comes back to that zipper, rests, and continues higher. That is a normal, that's the normal course of an auction. So even down here, where it looks like it just ran away without retesting, if I move forward in time, I'll find, so what was that price? 2038. Over time, I'll find that when we come back to that area, and I don't think we do today, yeah, we don't today, you'll find that that area gets a pause on the way down, especially if it's intraday. That's why my preference is to trade intraday. A lot of that stuff has memory right away. But that's what a zipper is. It's basically a consolidation, and generally the more volume it has, the more meaningful that zipper is. Here's a 15-minute zipper for tomorrow. So here's a very strong zipper. Look at the volume here, huge amount of volume. What does that mean? It's likely to continue higher. This energy here is likely to dissipate higher overnight. So my expectation is by the time I come in tomorrow, this overnight high will probably be way up here somewhere before the market actually finds its sellers and starts to move back to consolidate into the open. Okay, this is just normal repeating auction behavior.
Okay, I think that is it. If you have any more questions, please feel free to email FT71. Can you give them your email address again?
Yeah, my email is right here, info@futurestrader71.com, or just go to future71.com and hit the contact button at the top, and that way my associates can get that and get an answer to you more quickly than I can, and we'll do our best to get back to you.
And you can also use the AMA thread on Futures.io to ask any questions publicly if you want to.
Absolutely.
I want to thank you, FT71, for awesome webinar, great info. I always enjoy watching, and it's an honor to be here talking to you today.
Thanks.
So,
I appreciate that. Thanks for having me.
Most definitely.
Thanks. Take care, everyone.